chaos is a feature of how this goes, and that continues. And I thought it was interesting listening to your discussion about this sort of April 9th make-believe deadline, I guess, because we're still in the escalation phase, right? Like if that's like some point where they de-escalate, it still feels a long way away, because you have China that just came out saying that they're slapping tariffs on US goods. We're still in the phase where the Europeans are putting together their response, right? So you still have additional retaliatory measures coming. And this comes after the administration, guiding the trading partners to not retaliate. They're not really listening. So I wonder how that goes over at with the White House. So I think it's foolish to think that this is the end. I think this is an ongoing sort of shock to the economy.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice, because it's not. Here we go.
Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, life, and tariffs. It is the 4th of April, 2025. I am Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Most of the charts that we reference are posted to our Twitter account, so you see those there. Neil, I can't think of many times in my career, which spans about 35 years, that payrolls haven't been kind of the number one story of the week, but they're not. But I'm still going to give you the floor. So what do we see off of payrolls this week?
Well, it's it's like anything. I mean, you can always sort of choose your own adventures with these reports. I'll just highlight a couple of points that stood out to me. First, the prime age employment rate, that's those aged 25 to 54, that fell for the 4th time in the last 6 months. It's down 0.5 percentage point over that 6-month period. It's very rare to see that happen outside of a recession. So, the fact that prime age employment rates are going down is not an encouraging sign. Wage growth is slowing down. So if you look at, as of March, average hourly earnings rose 3.8% against the same month a year ago. That's the weakest since July. Normally anything below 4% for wage growth is kind of in the strike zone for the Fed, because productivity is running about 2%. And there were some downward revisions to the previous couple of months. So even though March beat expectations in terms of non-farm payrolls, the prior months were revised down. So maybe suggest we had a little bit less momentum going into all this than we initially thought. And then finally, about half the job growth came from private education and health services. But I think what's interesting about that, well, not half the jobs growth so far this year, excuse me. Education and health continues to add a lofty number of jobs. It's about 70,000 over the last 3 months. It's really hard to see that continuing, because the work week in that industry has rarely been lower than it is today. So, we tend to think that hours lead bodies, and if the work week is so low, it doesn't really make sense to be adding this many bodies. So that's going to be a source of support for that's going to be less a source of support, I think, for jobs growth going forward.
And as you think about the world, in terms of what this does to the Fed, if tariffs weren't happening, this were in isolation, any shift there in terms of the Fed's thinking?
I don't think it would shift things much one way or the other, but I would just say that to me, it's consistent with an ongoing cooling in the labor market. What we have so far is a very linear cooling in the job market. The risk with what is happening right now with respect to financial conditions, trade policy, and so forth is a nonlinear increase in the unemployment rate. So we're kind of moving in this direction already. The question is, does a linear shock or a linear sort of increase in the unemployment rate become a nonlinear one?
Right, right. Well, let's not be tone deaf here. Let's think about tariffs and bring Steve in. Steve, as they say, you picked a hell of a week to stop sniffing glue. How's it feeling out there? So first and foremost, let's talk a little bit about this calculation and how we came up with, or how the administration came up with this idea of what is really unfair trade, and adding the tariff back. And there's two things that are troubling there. One is it's really a trade deficit, and those happen all the time. That's really the definition of comparative advantage, right? Some country makes something more cheaply because of their labor or their expertise, their resources, and you want that because it's better for the world. That was viewed really as a liability, and I thought most interesting, and I go deep with some of this stuff, is it was very consistent with when you put that prompt in AI, whether it's Grok, whether it's ChatGPT, Claude, whatever, they say the same thing. Which the question is this really kind of the first iteration of an artificially intelligent driven war? With it's a miscalculation on the part of the administration. Thank goodness this is just trade and not something bigger. But clearly, the market seemed to be bracing itself for something bad, and this was worse. And I think as much as anything, at least from my seat, it was worse because it doesn't really make any sense. I get crazy can be helpful in negotiations. I 100% agree with that, and I can see how that works. But this is, I don't know if that's really what you want. So talk to us a little bit about that and what the consequences are.
Well, I think you're right to point out that this definitely was worse than what people had been anticipating in terms of providing clarity. I think heading into this, we were sort of asking ourselves, is this the beginning of the end or the end of the beginning? And honestly, at this point, it feels like maybe just more the beginning of the beginning. With respect to the economic analysis that was supposedly conducted, my guess is the administration would probably try to point to, hey, we need to look at the trade deficits because they capture both tariff and non-tariff measures and account for that. Like, I think to your point, it probably seems like a little bit more reverse engineering. There was a desired outcome, and they sort of looked for a way to sort of work that way back. It also sort of, I think, was catching people off guard because you had a lot of reports of other countries making a lot of concessions heading into this announcement. And so I think the thing that I'm watching for next week is we have this April 9th day when the reciprocal tariffs are scheduled to take effect. And I mention that because President Trump used IEEPA, which was the authority he used to impose the fentanyl tariffs. And if you recall, he opposed the fentanyl tariffs before, particularly on Mexico and Canada. When it got closer to that original date, he delayed it another month. And ultimately, he ended up following through with those and sort of ended up providing some exemptions. But I guess that's sort of what I'm watching is, will we see some negotiations to maybe potentially extend that April 9th date further? I think that would be a positive development. But really, the ball's in other countries' courts right now. You had Treasury Secretary Scott Bessent saying, don't worry, these are going to be the caps. But the big assumption is that countries aren't going to retaliate. And again, I think that's sort of the thing to watch. If this is political theater and it's sort of been negotiations for a while and sort of set up to make Trump appear, tough, being sensitive to the perception that his bark is worse than his bite, and that negotiations are a lot further along than we think, then maybe we'll again see that date delayed. Some of these other tariffs start to roll off. But if other countries start to retaliate and they start to sort of bet that Trump's going to feel pressure here, we've seen the decline in the markets, some of the political pressure, then I think that's sort of the risk for an escalatory trade war, because Trump's going to respond if they retaliate. And I think they're going to feel pressure to respond after that. And so I think that's sort of the uncertainty. And that's the thing that I just don't really see going away anytime soon. And perhaps that's one of the things that the market's still trying to digest.
Yeah, I mean, look, in politics, you need an off ramp, right? You need to look good in this whole thing, and so that seems to be the loggerhead here. How do you do that without looking too weak? How do you come to concessions without looking too weak, and obviously retaliation starts to escalate all that, which is troublesome for sure. And how important do you see this? And maybe that's what this weak buffer is, right? They go into effect, I think, at midnight next Thursday. So how important is that buffer? Was that him extending? I don't want to call it an olive branch because clearly that's not what that really is, but at least a buffer zone that is implying we want to have conversations. I certainly would not want to be in the administration right now because these guys are working the phones 24/7 having these conversations. And, I don't know if you're country number 27th on the list, how much you're seeing the the phone ring. But is that part of the calculus? Do you think that it's this buffer zone to allow some time to let cooler heads prevail and come to an agreement?
I think that's the hope. That's the optimistic case. Again, if Trump wanted to impose the tariffs on that day, he could have. So, sort of, why did you leave this lag in the effective date? It's going to be very difficult to have hundreds of bilateral negotiations. I think the other thing that caught folks by surprise, not only were the tariff rates, and to your point about the calculations, much higher than people anticipated for the reciprocal one, but also this universal baseline tariff. I don't think that people, myself included, were anticipating that that would be part of this. But now what we're hearing from the administration is that's sort of designed to prevent countries from sort of shifting away from where the tariffs aren't going to be applied potentially to lower cost production areas. So that way it's sort of like, hey, if it's the goal here is to try to increase U.S. domestic production, then I guess that's why they sort of have that in place. But perhaps that's left in place a little longer. I think that the real concern, you talk about sort of the disconnect between what the administration is asking for. You sort of hear three different desires, outcomes from tariffs. It's, protection of certain industries, although I think that's more the sectoral tariffs at 232. You have desired trade concessions and you have revenue, but those things are in conflict with each other. You can't get all three. And so I think that sort of feeds into the uncertainty over the duration and also the application. Are we going to start to see exemptions, moving forward of this? And so, I get the administration saying that the intent is to try to incentivize businesses and relocate and increase their investment here. That's just very difficult to do given that cloud of uncertainty hanging over your head. And moreover, when you're using executive orders to impose these, it is very likely that if you have an administration from the Democratic side in 4 years, that they're just going to simply undo these. So, we all live, the three of us live here. I want the U.S. to do well. I don't want to root against it. I'm just at this point sort of skeptical as to can we really get there?
Well, and you bring up a really important and good point, and we'll let Neil hit on this too, which is, if you look, we make capital allocation decisions all the time in our business, but it's really about, do we buy this database? Do we buy computers? We're not building plants, right? That's just not what we do. But if that's something that you do, that's a very hard thing to work into the calculus. Not to mention, it's got an extended life. I mean, you build plants and you're talking about a 30-year extended life. So executive orders wiping those things out. That's always been the problem with executive orders, right? I mean, they just don't allow for the continuity that you really need to effectively run, whether it's a business, a country, or your family for that matter. Neil, you've talked about, and I think put it really eloquently, which is tariffs are not an on-off switch; they're a dial. Certainly feels like this is Spinal Tap, and we've taken that dial to 11, right? Just in case you need a little bit more. Is that a bug versus a feature, right? Where it allows for a non-binary event, which is a sliding scale, which sort of keeps the uncertainty in a perpetual state of motion.
No, I think that's right. I mean, to me, chaos is a feature of how this goes, and that continues. And I thought it was interesting listening to your discussion about this sort of April 9th make-believe deadline, I guess, because we're still in the escalation phase, right? Like if that's like some point where they de-escalate, it still feels a long way away because you have China that just came out saying that they're slapping tariffs on U.S. goods. We're still in the phase where the Europeans are putting together their response, right? So you still have additional retaliatory measures coming. And this comes after the administration, guiding the trading partners to not retaliate. They're not really listening. So I wonder how that goes over at in the White House. So I think it's foolish to think that this is the end. I think this is an ongoing sort of shock to the economy. And yeah, I mean, if you're a business, the uncertainty story is becoming more evident because what's what costs less, right? I mean, do you want to bring in production into the U.S. or do you want to wait it out and not do anything and see if this is over with in 4 years?
Yeah, I mean, it's the uncertainty, and if you take uncertainty and you apply it to the markets, obviously the markets go down. But think of something a little longer term in nature, right? The lack of certainty or the rise in uncertainty lowers multiples, right? Because you don't have the same consistency, and so when your variability increases, you obviously demand more of a discount than you would with certainty. So just keep that in mind. A little bit more philosophical, fundamental, if you will, but that's certainly one thing that that does tend to happen around uncertainty. So from our standpoint, we've talked about sentiment being in the right slot, and clearly it was and continues to be. A couple things happened this week, and most notably yesterday. We've been in the camp that we were 85% there, that most of the things that we look for some type of good tactical low, and let's differentiate between tactical low and a longer term secular low. Tactical lows tend to be within a trend. They tend to provide some short-term relief. Oftentimes, I'd say about 65% of the time, they go and re-establish the trend. So that is historically in your favor. But the tactical lows are really about kind of a 3-month outlook, 3 to maybe 6-month outlook. And so they're not about, what's going to happen the next 1 year, what's going to happen the next 2 years. Those are really more trend momentum based, and obviously get into some of the fundamentals and Neil and Steve's work. But from a tactical standpoint, one of the things that we hadn't been seeing in the markets, even though the sentiment data was all, for the most part, very, very complementary and confirming that we were in some type of decent zone. One of the things that we hadn't seen was really a flush in the put-call ratios. And the idea here is that when there's more puts traded than calls, what it implies is that there's more interest in puts, and that interest in puts is usually because people are looking to protect the downside. Once you get through a certain threshold, and for us that number is about 1.3, in other words 130 puts traded for every 100 calls. Once you get through that threshold, historically it implies that not only are people protecting themselves, but they're actually trying to profit. And so when people start to profit or try to position themselves to profit from more downside, it usually is getting to that point of self-extinguishing. So we like to see that. We saw that yesterday. It was the first time that we'd seen that in this decline. I'll give you some stats around that. Historically, when we see that, we have an 83% chance of having higher returns out the next 3 months for the S&P. But I think more interesting than even that, the average return when you have a winner, and again, that's 83% of the time, that return is about 6% over the next 3 months. When you miss, in other words, that 17% of the time that it doesn't happen, your downside is only 2.2%. So not only do you have a higher probability of winning than losing, but when you win almost 3 times as much as you lose. And that is what we call, on my side of the business, a high expectancy proposition or game. Keep in mind, I'm a speculator. I make my living speculating. That's how we think about the world. But that's one of the ways, or one of the things that we're seeing. Neil, I want to touch on something that I noticed yesterday and get your reaction to it, because it can be a little bit of a sentiment indicator. But it also is just in sharp contrast to some of the rhetoric that we're hearing from pundits, which I know the three of us officially are pundits, so I'm not throwing spears here. But the 5-year forward inflation expectations, and I'll explain what that is for people, cracked to a new low. It's down below 2% now. Essentially what 5-year forwards is the implication of where inflation is going to be for the next 5 years, starting in 5 years, right? So in other words, starting in 2030, what inflation is going to look like through 2035. And the reason that you use that is because it gives you some good sense as to where people's expectations are, not necessarily at the gas pump or what the price of avocados are or eggs, but kind of the long run expectations of where things are. What do you make of that? Is that Do you think an overreaction to maybe recession fears, or do you think the whole hubbub about tariffs being, long-term massively inflationary might be overdone? Or none of the above? I'll give you that choice too.
I mean, I think the growth effects of tariffs dominate the inflation concerns around tariffs. That's what that tells me, right? Like, so I mean, of course, we know that the inflation market, right? I mean, tips break-even rates, and I mean, these are highly correlated to oil, which is one reason why Janet Yellen famously called these measures of inflation compensation, not actually inflation expectations. So the fact that oil is down because recession risk is getting repriced is probably pulling down some of these break-even inflation measures. But I think, to answer your question, it just tells me that the growth effects are more dominant.
And so the other thing that I noticed, particularly yesterday, but a little bit more earlier in the week, was this this rhetoric and this wrath, if you will, out of the administration, really pointed eastward. I mean, for the most part, towards China. We really haven't seen. Now that the markets were closed there last night, but we really haven't seen an outsized impact on the equity markets in China or Hong Kong, which, I find part of what I do and how I think about the world is when I see price action that's distinctly different than what I would expect from the headlines, I take note. And usually because there's something else going on that people are missing in the consensus. Any insight, any thoughts on what might be happening in China that the markets are not responding as bearishly as we're seeing out of Europe, as we're seeing out of the US, as we're seeing out of about everyone other than maybe Mexico?
Well, I don't. I mean, I think. I mean, maybe people are holding out for. I mean, do they have some kind of devaluation? Do they have some sort of like something in their quiver to kind of offset the shock to their own economy?
Right.
That might be what's going on. I mean, I would just point out though that I think I read just this morning that the Golden Dragon Tech Index or something is down quite substantially this morning. So I think it's like off 6% as I'm talking. What I find interesting about the price action so far today is that the U.S. is actually outperforming, right? Like, so the dollar strengthened a little bit. So you're getting some of that safe haven aspect coming back. So yesterday, the day after Liberation Day, you didn't, or Obliteration Day, as I call it, you basically had most of the weakness centered in the weakness was largely centered in the U.S. The dollar sold off, right? And now you're beginning to see this spread to the rest of the world. I mean, it's not like it's not affecting us as well, but you are seeing places like Europe underperforming the U.S. market, like China underperforming the U.S. market. So, I think that, that transition is kind of interesting from day to day.
Yeah, we saw yesterday, we call it negative volatility alert for the index, and that's just kind of measuring a statistical measure as to how volatile things are, and how volatile they are today versus the history of the index, and that triggered for the S&P. What was interesting is 36% of the constituents within the S&P also triggered, so it was relatively broad-based. I know that's not 100%, but 36% is a big number. It's certainly the biggest number that we've seen since COVID. So usually, again, that kind of mass selling or concern ends up closer to a low than not. One of the indicators, I'm not going to give it away here because we give away plenty. If you want to read about it, you can go to RenMac Access and become a customer. One of the indicators that we look at and that we haven't seen has not yet triggered. And I was shocked, frankly, by it yesterday. It was very close, but it hasn't triggered yet as kind of that final flush when we look for that flush indication. So we got the put call. We didn't get this indicator, but we did get 36% of the names in the S&P with those negative volatility alerts. And so I'm on the West Coast. I've been on the West Coast all week. And really what I'm telling clients and having conversations about is, this is the point where you have to start thinking about what can go right, not what can go wrong. When sentiment gets this extreme, one of the interesting things is you actually don't want to buy good charts. You want to buy bad charts. You'll get these bounces, you get these rips. And we certainly think that the conditions are right for something like that. Yesterday, 36% negative volatility alerts with the put calls certainly helps that with some of those stats. So, if anything, what I just encourage listeners to think about is don't dwell so much on what can go wrong. Clearly, things can go wrong. We're not saying that. But instead of being more skewed towards what can only go wrong, think about what can go right, because that's usually a much better psychological place to be as an investor, as a speculator, than buying into the consensus and ensuring yourself that you're just going to go with the crowd. So look for those glimmers of hope. One of them might be the Fed. I know the Fed's not going to be able to solve a trade war, but what is your thinking on that now, Neil, with the Fed? Is it a May cut? Is it sooner? Is it a June cut? Where are you on that?
Well, I think they'll cut in June. I think right now their policy is to be behind the curve at this point. I mean, they're very reactive. They pivoted in December. I criticized that decision at the time because I didn't think it was wise to sort of take out insurance against the Trump administration before they even walked in the door. But it is what it is, and Trump has basically given them every reason to justify that pivot in the Fed's defense. But they have a policy of being reactive. So you basically need to see, they're waiting for something really bad to happen in the data before they do something. And, chances are, if you're waiting for something bad to happen, the bad thing will happen. You're tempting fate in a way. And, so I think they go in June, but I think the fact that they're not going sooner probably is why they'll be cutting it. They'll end up cutting more than markets presently anticipate. To me, I think they go 4 times. I think the risk is that they go every meeting after June. So it could be up to 5 times. But that's sort of what I think. I mean, we're in a situation now, as I mentioned last week, where total compensation growth is running below the rate of the overnight Fed funds rate. I mean, to me, that's a sure sign of tight monetary policy. And that probably is going to continue. I mean, given all the things that are happening. So this sort of passive tightening of policy keeps going on. And, ultimately, there's so much of the Fed so much of that to the Federal stomach, and they'll end up cutting more.
So I was just wondering, because now you have, looks like the Fed going to cut rates. You have oil prices coming down, the 10-year coming down. I know the administration said these were their desired goals. I'm just not sure this was the way they wanted to get there.
Yeah, this is like the rough equivalent of one of our clients pointed this out to me. It's like fixing a tooth with a Glock 45.
Yes.
I mean, this is sort of the. What Steve is doing is the 4D chess theory, right? The 4D chess theory, and the risk with trying to engineer a recession to get interest rates down. I mean, recessions are never linear; they're always nonlinear. So once something gets going, it's hard to make it stop. That's problem number one. I've also heard this theory about, well, they're going to get interest rates down and refinance the debt and help, ease budget deficit concerns as a result. Well, I think that's a problem for the government, number one, because if you do that, you're going to have a lot more unemployed people. If you have a lot more unemployed people, that means less revenue flowing into the treasury. Oops. And for households, what bank is going to let someone? I mean, credit's going to tighten, so banks may not be as willing to help people refinance their debt as otherwise would be the case, right? Because they'll look at people as bad credits. So they might, you may not really be helping that many people because the strong credits are already termed out. So I don't know that it's the wisest maneuver. I mean, congrats, I guess, on getting interest rates down, but I think. Getting interest rates down and still having home building stocks break down to new lows is not exactly a good combination for the broader economy or the equity markets.
Well, and speak to this a little bit too, which is, if deficits are in their crosshairs, one of the worst things you can do for deficit control is have a recession. I mean, that's a disaster. Like you do not want to have a recession into the fight of getting the
I
deficit
just
down.
think, like we're talking about this, Jeff, and like all this stuff. I just think it's like this is like so much more simplistic sometimes. I mean, than I think we make it out to be, because we're trying to actually analyze it, and it comes back to a point that we've all kind of said here before. The man believes he was spared an assassin's bullet to do this. Like I remember. I mean, if
In Blues Brothers Paralance, he's on a mission from God.
yeah, and the thing is that if you've gone your entire life and people are, oh, that's going to come around and bite you, it's going to come around and bite you, and it never does. Like it's like I think Chris Rock talked about him as like Mr. Magoo, like nothing's ever going to happen. Right? Like, so how are you going to tell him otherwise, right? If someone does the opposite of what you think they should do and ends up becoming president of the United States, which one of you is the moron? Right?
Yeah.
Twice.
So, this could be the classic like F around and find out moment. But this is one of the reasons why I say like the pain is I mean, this is game theory. We're in game theory, not economic analysis, market
Right.
analysis
Right.
point right now. This is game theory, right? And so you have to ask yourself, politically, does it make any sense for him to back off? I don't think so.
Well, let me add
do
something
not
to
think
that.
so.
Let me add, because I totally agree with that. But the other point, and I will say, as much as we've been critics of some of these things, the one thing I will give him credit for is he's very good at finding the pressure point, right? He's very good at understanding the leverage. In fact, before I came out here Monday, I watched The Apprentice, which was the movie based on him.
Yeah.
I mean, very well done, by the way. So kind of channeling the Cohen mantra, right? Like, what is the leverage? What's the pressure point? And maybe we throw it back to Steve, but do we have enough, or does he have enough leverage, as the USA versus these others? Well, it's using the chessboard of military help and tariffs and what you guys are doing to us versus what we're doing to you. Who has the most leverage in this? Because I think that goes a long way to his thinking and whether or not he will back off or back down. And I haven't seen, and I could be totally wrong on this, but I haven't seen many instances where he doesn't have leverage and, comes out with a chest puffed up, right? I mean, he seems to be pretty good at that calculation.
As he likes to say, as he told Ukraine President Vladimir Zelensky, he believes he has the cards. And I think going back to where maybe we began the conversation with the trade deficit, I think from Trump's standpoint, what the U.S. has to offer is our large consumer base. And because of these trade deficits and the size of our economy relative to others, on a bilateral basis, the other side, he believes trading partners have more to lose than we do. And that's where you get into, Neil said, the game theory. We're just in sort of this game of chicken here. And because Trump is not facing re-election, I know he sort of teased the idea of a third term. Frankly, I think that was to get the story away from the signal coverage and also maybe suggest to other trading partners right now is, hey, I might do this because I may be around longer than you think. So don't think that I'm a lame duck. But because he's not going to be held accountable by voters again, he may have a little more leverage on the political front than the other side may be accounting for. So I guess, you talk about what is the off ramp here for some of these, negotiations. Again, you have to see whether these other countries sort of band together. And that's sort of what you hear from Europe is sort of suggesting is, hey, let's all do this, more this multilateral approach. So cumulatively, we have more leverage relative to Trump. And I think Trump's just sort of trying to pick them off sort of one by one. And even within different countries in Europe, sort of going, hey, do you really want to go down this path being pushed here by Macron? The thing that I would watch for when you start hearing some of these proposed retaliation plans is when is their effective date? Are other countries going to sort of announce the retaliation? But if they have a delayed effective date, to me, that suggests that they're still at this point more interested in the negotiation. And you talk about what's the off ramp. I think Trump's been pretty clear. It's reduce your trade barriers. Ideally, it's increase your investment in the U.S. And then if you want to get to the 3 or 4D chess argument, are you going to start pursuing some of these things that were written about in the Mar-a-Lago Accords? So I think that's sort of the thing to watch moving forward.
So, one of the and I haven't seen it, maybe off the top of your head, how are the polls? Have the polls shrunk here? And maybe we need another week to get that. But does the country, quote unquote, still feel like it's moving in the right direction? Because as of the last time I saw, it was still about where they were in December. So it was 27% around the election. It's about 44 or mid 40s, maybe 46% in December. And then what I saw at the beginning of March, or maybe mid-March, was still right around that 46. So even though we had seen the market correct, we had seen some of the rhetoric come out and some of the hostilities, the voters were still believing that the country was moving in the right direction. Has there been an update on that? Do you have any sense on that? And then why don't you work that into the elections in Florida and the election in Wisconsin, and whether there was any messaging around that?
Sure. So in terms of the polls, we haven't seen polls taken after Liberation Day. And I think if we do, it surprised me if people don't take out some frustration to pollsters, seeing that a lot of their capital gains were liberated from a lot of these announcements. I think the thing that sort of jumps out at me sort of is polls aren't moving that much just because we have a lot of polarization. I don't think that should surprise too many people. When you look at where Trump's approval ratings are, it's a little bit of an inverse to where he was in his first term. Trump is actually getting higher approval ratings, particularly on the issue of immigration and deportation, even some of the federal spending cuts and the focus on reducing the deficit. Where he's completely inverse is on the handling of the economy. And that was last time sort of his saving grace, is that's the most important issue to many voters. And I think what you see in the polling data prior to Liberation Day, again, I think it's only going to make it worse, is voters still remain concerned about the economy. They're still very frustrated about prices, which is how most voters sort of define the economy as they see it. And they think that Trump is paying too much attention on the tariffs and not enough attention on bringing prices down, as he sort of promised during his campaign. So I think that's sort of the political concern moving forward, is if companies are going to face cost pressure here. Now, are they going to increase their prices, or are they going to lay off people? And neither of those are particularly good for Trump. And I think that's where you need to sort of watch where the polls are headed on that direction. And then with respect to the elections, I think both sides really read too much into this, to be honest, in terms of these midterms. I just look back, a few years ago in 21, Republicans won the gubernatorial mansion in Virginia, and they came very close in New Jersey. Everybody thought a big Republican wave was coming. I thought that candidly probably had to do more with frustration over COVID. 22, Democrats overperformed midterm expectations. And everybody thought, or many political prognosticators said, abortion was going to be the defining issue of 2024, and yet Trump won. So again, I would just sort of pump the brakes here. At the end of the day, we had what I would consider a status quo result. You had 2 Republican-held seats that remained in Republican control. Granted, they were lower margins than they were in 24, but Trump was not at the top of the ticket. So, it is a different, smaller electorate that used to favor Republicans. I think now you're just seeing the shift of suburban voters in the favor of Democrats, which is why Democrats may perform a little better in these special elections. And then you look at what happened in Wisconsin. I think it's sort of, again, where you view this race sort of depends on which camp you're in. Democrats are sort of touting the fact that, we maintained this judicial seat that was held by Democrats, sort of this 4-3 Supreme Court majority there, despite Elon Musk spending $20 million. So I think what Republicans see is, look, yes, Musk may have spent $20 million, but overall, the Democrat candidate, I think, spent twice as much as the Republican candidate, and won by a small majority in an environment that should have been more favorable to Democrats. So again, I just think there's really not much to take away from this. But moving forward, I think that's sort of the thing to watch with Trump and these tariffs, is that you sort of feel that political backlash. And Republican lawmakers are going to feel it before he does. And that's when you get into, can he potentially face some obstacles on the Hill there for his legislative agenda?
Right. Well, and then does he care? Because if he's on that mission from God, does he really
Right.
care? Let's go to the mailbag. Harry Chen. Oh, look at this. This is from what is that show? What is it called?
Mr. Rogers.
Mr. Rogers' Neighborhood, right? So this guy's name is, like, I guess I was too young to really appreciate this, but the mailman's name is Mr. McFeely. I mean, the show's creepy enough, but you don't need a mailman named Mr. McFeely. All right, Harry, here we go.
Okay, today we have the question from C.Y. Wade. The question is, what is the strongest bull case for equities this year from here on out? Tariff resolution and clarity, or further growth scare, but no major deterioration? with the Fed jumping in on rates and possibly QE? Thank you.
All right, thank you. So what is the strongest bull case for equities? I like this because it does fit into our theme, which is, hey, let's think about what can go right, not what can go wrong. And that's not to be Pollyannish. It's just being contrarian. So what's the strongest bull case for equities this year from here on out? Tariff resolution and clarity, or further growth scare. So obviously lower rates, but no major deterioration in things like credit, unemployment, et cetera, with the Fed jumping in on rates and possibly QE. I've got some thoughts, but Neil, I'll throw it to you to hit that badminton back over.
Yeah, I mean, I guess the way I would answer that is that I agree that it's there's going to be a time to turn bullish. I'm not sure that now is one of those times, but if you had to put a gun to my head, I think at some point in the back half of the year, are we still talking about tariffs? Are we talking about the Fed cutting? Are we talking about more growth-friendly legislation making its way through the halls of Congress to the president's desk? I would say yes for all of those things, which would mean stocks would probably be going up in that situation, right? I mean, my view is that stocks have a propensity to go up in the absence of bad news. So if there's not as much bad news in the back half of the year, you should assume that stocks can rally.
Where are inventories right now? Are inventories running hot, lean, middle of the road?
Well, I mean, I haven't really looked at it. I mean, orders are getting worse. So, I think that's important. So orders are going down relative to inventories, which means that you'll probably see production cuts soon. So that's kind of where I'm at.
Yeah. Well, from my standpoint, I would echo your thinking there, which is obviously getting some path and clarity on tariffs because they are long-term taxes, right? So getting some clarity there would certainly be helpful, even if it is we're going to start at 20%, but we're going to ratchet this down as we go, with a path towards something that resembles, let's call it fair trade, not free trade, because that's really what we're talking about here. Something that resembles fair trade. And, this is kind of ongoing negotiation with this path forward, and de-escalating as we go. I think that would be good, along with these lower rates, which, if we look at our yield impact model right now, it's running about in the 50th percentile, which actually tends to be bullish for stocks. It's fine. So yields are doing what they need to do. Obviously, a little bit more juice out of that would be good news. And then if we can take some of this inflation pressure, which I think is in the cards, and I think, Neil, you would agree with this, that, what we're seeing out of energy, what we're seeing out of food prices, what we're seeing out of rents, what we're seeing out of things that can have a long tail towards better inflation data, are certainly visible here. It's just they haven't shown up in the actual numbers. And so if we can get that along with those lower oil prices, it really does set up for a decent midpoint of the year. Now, if these tariffs linger, if we have a trade war, if we start compressing margins, if we start requiring layoffs, it's a much different scenario, right? So we have to be careful of that. And to Neil's point, you're not going to be able to solve a trade war with lower rates, right? So I don't think we need QE. I don't think it's at that stage by any means. But if we can get some trajectory towards fairer trade, with this softer growth that we've seen, which was, by the way, and Neil's pointed this out several times, was happening in the fourth quarter. It might be accelerating here, but it certainly was happening. And if we can get something that is more accommodative on the rate side, and by accommodating, I talk about rates matching, or maybe even a little bit under where the 2-year yield is, that certainly tends to sit up more bullishly.
Yeah, I would just say, I mean, I really like the idea. So the fair trade back end, right? Like this sort of like, this is the classic, like, escalate to de-escalate. We want an even, I must say, like, I hope that that's the case. It would be good.
We all do.
Right? We hope that that's the case. I would just say the reason I'm somewhat skeptical of that, like, I do think that this is foundational. Like the fact that the sort of, basically it's all that, like, you look at these reciprocal tariff numbers, they're basically looking at bilateral deficits. So they're assuming that anytime you run a deficit with another country, that country's doing something wrong and not playing fairly. That is a fundamentally flawed assumption,
100%.
right? So that's why I say it makes it very challenging to negotiate in good faith if that's the starting point of the person you're negotiating with. So you have to, like, yes, that's why I say it's foundational, right? If all the goods and services that are consumed by Americans ought to be produced by Americans, then why not have all the goods and services produced by New Yorkers, consumed by New Yorkers, only be produced in New York, and we can't have any of that production offshore to California or New Jersey or Pennsylvania or wherever else. So it's foundational. Like that to me is like, we all remember the sort of Milton Friedman, how does the pencil come? Like that whole story. Like that's the foundational issue. Yep. Right? So I question whether there is a de-escalation off-ramp, because I think this is fundamentally what he believes.
I don't disagree with anything you said. The only thing that I would add is I do think there is some merit to the idea that there are some critical industries that we need to produce here in the U.S. and we can't be reliant on other countries.
Steve, he ran on universal tariffs of 10% and trade on China. So to me, that I totally, I agree with. Okay, I mean, people that know me personally outside of my day job know how I feel about some of these issues. But to me, it's a bit disingenuous to say we ran on going after China. The market's not selling off the way it is because you're only going after China, right? Like he's gone to actually beyond what he campaigned on, right? Like if you recall, on the day of the trade announcement, okay, Wednesday, when futures markets were open, or as it was happening, I believe, the initial reaction in the market was to rally. Why? Because people saw we're just going to have a 10% baseline tariff against countries. Then when he pulled out that chart, the infamous chart, telling everyone that we're going to tariff Lesotho by 90%, we're going after the vibranium in Wakanda. That's when the market started tanking, right? So let's just be, so this is what it is, all right? I mean, so that's why I say, like, it's foundational. It's foundational. If you're betting on the escalate to de-escalate, you have to assume that Trump is going to back off some really, really deeply held views around these things. And as I say, it's tough to teach an old dog new tricks. So that's kind of where I'm at personally.
Indeed. Well said. Steve, what's going on next week in DC other than all this nonsense and noise?
Well, again, just to reiterate, Tuesday, watch the United States Trade Representative testify, the Senate Finance Committee. Hopefully he will offer some clarity as to the administration's thinking with respect to its trade policy. That will come ahead of the Wednesday reciprocal tariff deadline. We can see whether or not that gets extended. We get some announcements before then. And then outside of tariffs and trade, the House is likely to pass a new budget resolution. The Senate is trying to do that probably through the weekend. Senate Republicans, again, the House and Senate need to pass this budget resolution to eventually pivot towards the reconciliation package. House wants to do it because they're in Congress in recess for 2 weeks after that. So that's sort of what I'm watching next week.
Neil, what's on the docket next week for you?
CPI inflation. That's out for March. Markets looking for a 10th on headline inflation. Remember, we are going to get some, I think, potentially good news on inflation next week. Things like egg prices probably come down a bit. Even car prices, right? I mean, so like wholesale auction prices had been slowing. So we're sort of in this window where some of the inflation news might get better before it gets worse. So we'll see. But that'll be the main event. And I'm also watching jobless claims. Continuing claims actually rose to a cycle high this week. Right. Like, so this is just a reminder that job finding rates are really low. And so even though you have a low level of layoffs, people can't find work. And so you have extended spells of unemployment. And then April, Michigan sentiment. Wonder which way that's going.
No doubt. Well, I'll tell you what we're watching, obviously, is these signs of exhaustion. We think we're, again, 90% there. There's a lot of good things happening around that. Let me just, preface one thing, and I'll tell you how I think about this in the PA. PA stands for personal account for those not in the business. But in the PA, this is about tipping your toe into the beta bucket here. Beta's in that 0th percentile in terms of performance. The other 2 times that we've seen that in the last 20 years, basically, is the summer low in 2022, and it was around COVID. So when beta just absolutely gets dismantled, they're not good charts. Trust me, they're not good charts. But it's the point when sentiment is running at its most bearish that you actually want to buy the bad charts. So I am dipping my toe into the beta waters here. Again, dipping, and then I add only on strength. That is key. You add only on strength to those things as a marker. So that's how we're thinking about the world. Well, join us again next week. We'll be 1 week older, hopefully maybe even 2 weeks older by next week, 1 week wiser. And follow us on YouTube and what's the other one? X, Twitter, for all of the charts that we reference. Until then, I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
We'll see you.